Fair value gap shows the footprint of big institutional traders who goes into the market with large sum of orders. These big institutional traders go into the market with large sum of money and it causes imbalance in the market. The good thing is that if you can spot these fair value gaps and trade alongside these big institutions, you will become very, very profitable. In today's video, I'm going to teach you guys how to trade fair value gap like a baby. I will literally take it and teach you how to identify fair value gap, how to identify a valid fair value gap, how to trade and find entry when trading fair value gap. So all I want you to do is simply smash that like button for me. Like this video, and if you are new to this channel, do to subscribe and turn on the bell icon to receive more of this kind of content. Now, what is fair value gap? Fair value gap is an imbalance in the market, and this imbalance is caused by large sum of orders or large sum of money that goes to the market. It can cause both in a bullish scenario and in a bearish scenario. I'm going to show you good example in this video. As you can see right here, there are three candles right as you can see right. So if you check, you're going to see that this particular candle is bigger than this particular one. Why this particular candle is bigger than this particular one? This is the candle that causes what the imbalance in the market. Now, I know you don't understand, but let me show you. In a normal scenario, in a normal candle, you are going to see that if you see three candles, you see that the wick of this candle overlaps with the wick of this other candles. Okay, there is no space. This is a normal candle, but a candle or a market that a big financial institution has entered, you will see that the wick of this candle and wick of this candle does not overlap. There is a space in between, and this space is called fair value gap. How do you identify fair value gap? To identify fair value gap, first you need to spot three candles: the first candle, second candle, and the third candle. Get into spot what three candles. One, two, three. This second candle should be bigger than this previous one, that the first one, and also sometimes bigger than the third candle. When I say this second candle is the candle that causes the imbalance. Get it should be bigger than this previous one, the first one, and this other one. And also this particular place you call it, this is the body of the candle, and this place is the body of the candle. This tiny place is what we call the wick of the candle. This wick of this candle and the wick of this candle should not overlap. There should be a space between them. It is this space that we call what fair value gap. Now let's go back to here. Right, just like I said, we need three candles. The wick of this particular candle, the first candle, and the wick of this third candle should not overlap. The space in between is what's called the fair value gap. An invalid FVG, which is abbreviation of fair value gap, you see that the wick of this first candle because other candle overlap. Let's say the wick of the two candles overlap or touch, there's no gap. So that this is an invalid fair value gap. There's no gap here to look up fair value gap. Now, for a bullish and for a bearish scenario, I'm going to go to the chart and show this, but I don't want to use this diagram to illustrate so that you guys will get better idea on this thing. As you can see, at three candles, one, two, three. The wick of this candle and this candle, there is space, so you draw a box on it, and this space is called fair value gap. For a bearish scenario too, the wick of the first candle, wick of the second, wick of the first candle, and the wick of the third candle, there's a space in between, and this space is what we call fair value gap. Now let's go to the chart. Let's identify these fair value gaps. Guys, on the chart, I already marked out the fair value gaps on the chart, but then I'm going to delete these particular ones that I've marked out. As you guys can see. For this particular one, right, you can see three candles: first candle, second candle, and the third candle. You get first candle, second, and third candle. You can see the wick of this candle and the wick of this candle. There's a space between them. You get it does not overlap. So what you need to do is to come down to this place, carry your horizontal tool, and draw a box. Draw a box and drag that particular box out. You get if you do like if you draw it like this is your what fair value gap, and you can um, zoom in and ensure you draw the post at properly. You get ensure you draw it out properly. Then it is this space that you call the fair value gap. And if you scroll over to this particular side too, I'm going to notice that big momentum candle, which is this very candle, which is like two times the size of this. And you can see between the wick of this candle and this, there's a space. And what you do, you draw it out, you get it draw it out. Now, how do you trade fair value gap? The thing is that for what causes fair value gap is actually imbalance in the market, because when these big institutional traders enter into the market, it causes an imbalance. And normally, when there's an imbalance, market will have to what cover up or fill up those imbalances. When market will do what to retrace back to that particular imbalance again and cover it up before market go up again. So I don't know if you understand what I said. So since you are seeing imbalance in this particular place, right? Caused by this institution. What they're expecting market to see is market to retrace down back to this particular place before going up. Yes, the same market will go before going to its normal direction, and that is what the same market did on this particular place. If you check, let me take the chart. You can see right there, the fair value gap on this particular place. The fair value gap right there. You can see market went up, retraces back, the market goes up again. And if we take a good look at this particular side right here, I can see that there is also under fair value gap. You can see a small first candle, second candle, and a third candle. And if you check very well, the distance between the wick of this one and that is now touch, you get. And you can see market went up, touches it, and goes higher. And if you look at this particular side too, you can see there's also a fair value gap. Right, so let me draw it out for you guys. And there's something I want you guys to know. As you can see, there's a fair value gap on this. But you can see market will not respect this fair value gap because why? This bearish candle mitigate it yet. So a fair value gap is can only be used once, it can't be used twice. As you can see, when this fair value gap created, market, this candle want to touch it, the market did not respect it, or rather market want to respect this other one. How do you know which fair value gap and market is going to respect? The number one rule here is that you need to break off structure. A fair value gap that leads to a break of structure, market always respects it. What do I mean? You can see on this case, there's a fair value gap on this particular place. But if you see this fair value gap do not lead to a break of structure. If you check, the highest point that this particular market went to previously was actually this particular place, right? Or this particular place was the highest point it went to that creates this low. So this place that creates particular low, and then see this when this fair value gap, the highest point it went to before it retraces was actually this place. Again, which did not break structure. There was no break of structure, no break of structure at this particular place. Get. But if you can see on this particular fair value gap, I think that this particular fair value gap, when market creates this fair value gap, it pushes up and breaks above the previous swing high, which is this particular place right here. And we check, you can see that market closes above it. Market breaks it. This line draw is not quite accurate. But market breaks above it before market do what? You can see that the market break above. You can see the IP the market went to right at this particular place. Market retraces. They did not tap into it, but when back, the market retraces and market finally goes up. You can see you should look for a fair value gap that leads to what a break of structure. Now on this particular place, on this particular right here, you can see there is a fair value gap market with a fair value gap at this particular place, right? This particular place. If you watch closely, this particular fair value gap that market created, this one, right, it went out to this particular place, and you're looking at this one will break structure. It is that it went higher than the previous high. This was the previous swing high. You can see market was price gold went higher than this one. It break structure, it could break US before it went at the top to this fair value gap and it went higher. So you should make use of what fair value gap that broke structure. This is the first way for you to identify a good fair value gap. Also, in priority is linked to fair value gap at the bottom in case of bullish case. Let me explain what this means is that in some scenario you might see multiple fair value gaps in some scenario in particular trade. Let me show you an example. In this particular scenario right here, you can see that there's a fair value gap at this particular place. There is another fair value gap at this particular place, but you can see market did not respect this fair value gap. It even got mitigated. Get market did not respect it got mitigated. The market respected this particular one before it went higher. Why the market respect this one? Because it was at the bottom. You get for a bullish scenario, you get give priority to fair value gap that is at the bottom in case you span multiple fair value gap at the same place. Give priority to fair value gap that is at the bottom. Now let's take a look at a bearish scenario. For a bearish scenario, this will be the example that I'm going to use. And so this is the first candle, this small red candle right here. This is the second candle, and this is the third candle. And if you check very properly, you can see that there's a very big gap between the wick of the first candle, if you can see, between the wick of the first candle and the wick of the second candle. If we call the first candle here and we call the second candle, there's a very big gap. And you can see it actually created a lower low again. There might be a break of structure again. And in a bearish trend, in a bearish market, what we need to see series of lower lows and lower high. You can see it created a lower low that was lower than this previous low right here, which is a break of structure before market do what price reverses back and went into fair value gap for market went down yet. And as you can see, on this particular place was one under fair value gap, and this can also create a new structure so that it breaks above what the previous low and price went down into it before price went back. Now, how do you trade this particular market? You get before you if you find fair value gap, don't just jump into it. What you need to do is for you to uh, make use of other conferences. What is mean that look for signals. Get against on this scenario, right? When price touch this particular fair value gap, you can't just enter this particular place. You should enter as you can see this place when price did what give a bearish engulfing candle. There's a candle that a big candle that engulf this candle. You can simply enter at this particular place. You get and put your take profit at the the previous lowest level. When there's no lower level, you can simply make use of something like a 1.4 to 1 ratio. So when market gives this bearish engulfing candle, you can simply enter this particular place and can make use of a 1.4 to 1 ratio. So let me show you what this simply means. So normally your stop loss should be above your fair value. Your stop loss should be above fair value, and your take profit should be around 1.4 is actually a very good take profit. You can see it is about 1.4, and if we are expanding, you're going to see that market really smash the take profit. Again, this simple way that you can use. So once you find fair value gap, it does not necessarily mean you should enter. You look for what signal for it to enter, something like a bearish engulfing candle, which you can see this particular place. You can see double top and any other chart patterns. And once you see this, before you can enter into this particular trade. If you have any question, please don't hesitate to ask me in the comment section. If you need to help, please do it to smash the like button, and you subscribe to the bell icon. Join my WhatsApp Telegram channels to get daily offers and signals. Let me see my next video. Peace out.